Good afternoon, or good morning, or good evening, depending where you are right now. My name is Jay Shambaugh. I'm the director of the Institute for International Economic Policy here at GW. I want to welcome you today to this event on the centrifugal nature of the labor market, an installment in both our Rethinking Capitalism and Democracy series, as well as our Facing Inequality series. So for those of you who are not familiar with IIEP is located at the Elliott School at GW and is a cross-school interdisciplinary research center at GW. We aim to serve as a catalyst for high-quality multidisciplinary research on policy issues surrounding economic globalization. We interpret that mandate quite broadly and support research and policy work on issues ranging from trade to finance to development economics to poverty studies or climate change and really economic policy more broadly. With a big focus often on issues around inequality. IIEP has been hosting a number of series virtually for the last year and a half on inequality, on China, on India, on rethinking capitalism and democracy, as well as a number of other events. Please take a look at our website to see more details, our YouTube channel to see where you can find prior events. So without further ado, again, welcome virtually to Washington, DC, to GW. And now I'll turn it over to IIEP Distinguished Visiting Scholar Sunil Sharma to talk about today's event and the series that it falls under.
Thanks, Jay. Hello, everybody. It's great to be back with my colleagues after a 2-month break. Today, we have the 9th seminar in the monthly seminar series on rethinking capitalism and democracy. And we are very glad to have it co-sponsored by the Facing Inequality series, also at GW. Let me say a few words on our seminar series. We started the seminar series on rethinking capitalism and democracy in November 2020 in the middle of a pandemic. The COVID-19 pandemic, like the global financial crisis before it, is forcing us to rethink the functioning of capitalist democracies. The challenges are many. Polarized societies and a lack of social trust, inadequate health and social security systems, high debt among financial and non-financial institutions, households and governments, deficiencies in corporate governance, weak government oversight and regulation of the economic and financial system, income and wealth inequality, and the destruction of the environment. The three spheres of well-being, political and social, economic and financial, and the natural environment have each become more fragile, while their complex interactions are producing some wicked challenges. Today's seminar by Professor Peter Dietsch examine one of the major systemic issues we are currently grappling with, the rise in income inequality. He argues that the very nature of the labor market contains a dynamic that leads to increasing wage differentials between skilled and unskilled workers. He examines to what extent such differentials are necessary and/or justified, and the implications for public policies. With that, let me introduce the speakers. I should also say that the Facing Inequality series has been discussing both existing and emerging issues in inequality, both in the US and around the world. Income inequality. So Peter Dietsch is a professor in the Department of Philosophy at the University of Victoria, British Columbia. His research focuses on the issues of economic ethics, notably on tax justice, normative dimensions of monetary policy, and on income inequalities. Dietsch is the author of Catching Capital, The Ethics of Tax Competition, Oxford University Press 2015, co-author of Do Central Banks Serve the People, Polity Press 2018, and co-editor of Global Tax Governance. What is wrong with it and how to fix it, 2016. Dietsch received the Friedrich Wilhelm Bessel Research Award from the Humboldt Foundation in 2021 and was nominated to the College of New Scholars, Artists and Scientists of the Royal Society of Canada in 2017. Our discussant today is a young high flyer, Kathryn Holston. She's an economist in the Office of the World Bank Chief Economist and a doctoral candidate in economics at Harvard. Since 2019, she has been a Stone PhD scholar in inequality and wealth concentration at Harvard. Her current work focuses on financial fragility during the COVID-19 crisis and banking crises throughout history. With that, let me hand the mic over to Peter.
Thank you very much, Sunil, and thank you to both you and Jay for the invitation to present. Thanks to Kathryn for having accepted to provide comments, and to the rest of you for being here, albeit virtually. It's a great pleasure for me to give this talk at the Institute for International Economic Policy. Let me share my screen. There we go. And let me start perhaps with the observation that there are several different ways to approach the issue of inequality. So some people will look at the negative consequences that inequality might have on different aspects of our society. So for instance, on democracy. Others look at the way that inequality comes about. So what economists call the determinants of inequality. And my presentation will fall into the latter camp. I will try to convince you that one particular determinant, one particular source of income inequality is often neglected. I'll argue that this determinant is rooted in the way the labor market functions, and I'll provide a perspective on what we should think of this determinant from a normative and political perspective. So to give you an indication of the direction of travel of the argument, think of two of the dominant explanations of income inequality that we find in the literature: globalization on the one hand and information technology on the other. So globalization expands the labor supply, particularly of unskilled workers, and information technology boosts productivity, particularly of the skilled workers. Now, what do these explanations have in common? They have in common that they're both supply and demand explanations. And those kinds of explanations tend to suggest that the labor market converges on one particular equilibrium at a time. And the determinant of income inequality that I'll present here is different. It doesn't question the importance of supply and demand explanations, but it suggests that they're not everything. Other psychological factors also play an important role, and taking them on board leads us to think that several different equilibria are possible in the labor market, some with higher levels of income inequality than others. Let me move on to the second slide. I hope that you're able to see some of the slides at all. Here's a schematic overview of what's to come. First, I shall present to you this determinant of income inequality that I'm focusing on, and which I think gets neglected. In a second step, I'll argue that inequalities that come about in this way are problematic because they're unjust. Now, in the presentation, I'll be relatively brief on that aspect, but we can come back to it in the Q&A. And finally, I'll look at the policy implications of my argument. So suppose there's something real to this neglected determinant of income inequality, and suppose also that I'm right in arguing that it's unjust. What can we do about this? We shall see that the remedies required to address it are quite different from the standard policies to address income inequality. Now, to understand the kind of income inequalities the labor market generates, we need to understand how the labor market works in the first place. This is not something that economists easily agree on, and in order to appreciate why the determinant of income inequality that I focus on is neglected, it's useful to contrast two ways to present how the labor market works. So the first approach on how the labor market works may seem obsolete because no contemporary labor market economists will actually subscribe to it, but surprisingly, it still has a latent influence on the discipline. The second one I'll present is, I think, as close to the state of the art on the subject as it gets. I won't go into technical detail on either, but I merely put them on the table to be able to develop my subsequent argument. So starting with the first perspective on the labor market, this is what is called the marginal productivity theory. So it's still the case that when you open an introductory textbook to economics today, you will find this marginal productivity theory presented. And applied to the labor market, the core idea is pretty simple. The firm will keep hiring workers until the value they add, until their marginal product is less than the going wage. Right? Now, the problem with this theory is that it only works under a very restricted set of assumptions. So perfect information, rational agents, constant returns to scale, and no externalities, for instance. Now, these conditions don't hold in the real world. Right? However, as indicated by the fact that you still find this marginal productivity theory in economic textbooks, it still has a latent influence on the discipline. And here are some of the forms that this influence takes. So first, this analysis of income determination treats the labor market just like any other market. So hiring a worker is just like buying a loaf of bread or buying a bicycle. Right? Secondly, individuals on the labor market are assumed to have no bargaining power. They are what economists call price takers, who will not be able to earn more than the value of their marginal product over a certain period of time. Third, in equilibrium, this theory assumes that the labor market will clear. In other words, demand will equal supply. And finally, the marginal productivity theory also sometimes has a normative component, namely the idea that not only will workers get the value of their marginal product, but they should get the value of their marginal product. Right? Okay, so very briefly, this is kind of the obsolete view, if you like, but it's still, I think, very important and useful to contrast this with a more sophisticated and empirically adequate account. So now I'm moving on to the second account. And the second account is what I call the core model, after the presenters of this model in an economics textbook that is called CORE, which stands for Curriculum Open Access Resources in Economics. Now here's a quote that nicely summarizes what this account says on wage determination. I quote, "The firm determines the lowest wage it can pay. It must not undermine the worker's motivation to work, and its decision is based on," and there are three factors, "the prices of other firms' products, the wages other firms are paying, and the unemployment rate in the economy." Now, I think it's very useful to contrast this with marginal productivity theory. Consider a first contrast. Right? This account considers that some involuntary unemployment is actually a necessary feature of the labor market. Why is that? Well, because unemployment acts as a motivating force for workers. Without unemployment, there would be no cost attached to job loss. Right? So as a consequence, in contrast to the first model, the wage on the labor market will always be above market clearing level. Second contrast. Consider the three, now this is where it's unfortunate that I don't have the slides, but consider the three factors employers will consider when setting a wage. They show that there's an important amount of discretion in the wage setting process, right? So firms will, one, tend to pay lower wages when there's more competition on the product market. They will tend to pay higher wages when the other firms are also paying their workers higher wages, and they'll tend to pay higher wages when unemployment is low. Right? But within that, there's quite a bit of discretion, and that's a marked contrast to the model of marginal productivity theory. Third, this account says that the labor market is actually very different from other markets. Right? No one would go to a baker that offers the same loaf of bread for $5 if you can get it next door for $4. Right? On the labor market, this happens according to the core textbook all the time. Here's a quote from them again. "Paying more than is necessary to buy the employee's time is not throwing money away. It is the way that employers get what they want, namely work, and to make profits." Fourth, this also raises another important question. Why is there no underbidding going on the labor market, or hardly any? Right? Why don't employees go up to their employer and say, look, I'm going to do the job of that person over there, but for less? Right? Now, the short answer is because employment contracts are incomplete contracts. The employer can't fix the amount of effort that the employee will put in. And in order to motivate them, they pay them a little more, and it's very hard to underbid them from the outside. Now, finally, this account emphasizes that even when wages are above the market clearing wage, employers will be reluctant to cut nominal wages. Why is that? Because it threatens to undermine that central motivation of the workers. Right? In economics, there's a whole literature on the phenomenon of wage stickiness, both theoretical and empirical, and I'm not going to go into detail, but I want to point out one implication. Right? When a firm is faced with a choice between laying people off and lowering nominal wages, they will often go for the first because they do not want to undermine the motivation by lowering nominal wages. Right? So in sum, this second account is more empirically adequate. And the core feature that I want to underline is that there's a lot more discretion in wage determination on this account because there's the distribution of a cooperative surplus compared to the perspective of marginal productivity theory. Okay, so now we've got all the pieces of the puzzle in place to get to the heart of my argument. What I do with this, what I call the core model of the labor market, the sophisticated, empirically adequate one, is that I tweak it in a number of ways. So first, I assume heterogeneity on the labor market. So there's a skilled segment and an unskilled segment of the labor market. And second, I look at wage setting over time rather than in a static framework where we just look at one moment in time. So what impact does that have? What impact does thinking about a heterogeneous labor market with skilled and unskilled people have on income determination? And I think here most people would agree that the skilled will have more bargaining power than the unskilled and receive a wage premium, right? So think back again to some of the things we saw in the core account of in the core model, right? The unemployment rate among skilled workers is lower, which means that they're prepared only to work if they're paid more income, right? And that means employers will be prepared to pay them a wage premium. Other explanatory factors are that the replacement costs tend to be higher for skilled workers, right? So I simply wish to point out that someone who accepts the assumptions of the core model will also accept that the skilled will get a wage premium on the labor market. It's pretty uncontroversial. Second, what do I mean by a dynamic framework to analyze wage determination? Well, I mean that we look at the behavioral responses of agents over time rather than looking at one particular moment in time, right? And all of this so far, I think, is entirely compatible with the core model. So what's different what changes when we look at wage setting over time in the way that I've proposed? Now, at this point, two concepts from behavioral economics become relevant, and they are, one, the endowment effect, and second, the notion of the reference transaction. So you might know the endowment effect from experiments. There's a whole host of experiments that have been done, like the coffee mug experiment, right? So you've got two groups, and the members of the first group are given a coffee mug and then asked for how much would you sell it. Right? The second group doesn't have a coffee mug and they're asked for how much would you buy it. Now it's interesting, there's a huge difference in the prices they give. The people who have a coffee mug already give a higher price than the one who are asked whether they would buy one. Right? And this suggests and shows that human animals value things in their possession more than they would pay to acquire the same things if they didn't have them already. Right? Now, to see how this is relevant for the labor market, consider the following somewhat stylized account of wage determination over time. Right? Suppose that the skilled on the labor market obtain a wage premium in time T1, right, due to their bargaining power. We said that that's pretty uncontroversial. Right? Now, over time, they will start to feel entitled to this wage premium. There's an endowment effect. Right? Now, this endowment effect makes it costly for the employer to take that premium away again by lowering their nominal wages. Remember, the core model said there's hardly any lowering of nominal wages going on. Now, what's interesting is not just the skilled, but also the unskilled will come to accept this wage premium, not only as normal, but also as fair. Right? So in time T2, the skilled plus wage premium becomes what you can call, with the terminology of behavioral economics, the reference transaction that gets incorporated into social norms on the labor market. So here we've got the second notion from behavioral economics, which is this idea of the reference transaction. Maybe to illustrate that, I can give you a quote from a paper by Nobel Prize winner Kahneman with his co-authors Knetsch and Thaler. They say, it should, I quote, "It should perhaps be emphasized that the reference transaction provides a basis for fairness judgments because it is normal, not necessarily because it is just." Right? So people start to accept this. Even those who are not privileged by it, who are disadvantaged by it, start to accept it because it's normal. That's the way things are done, not because it's just. So finally, to complete our stylized account of how wage determination happens from this perspective, look at time T3, right? I argue that because the bargaining power of the skilled is undiminished, this whole process can start all over again. Right? So the skilled can get another wage premium after the old one has been normalized. Right? So this is what I call the core plus model. The core model plus these assumptions of heterogeneity, dynamic wage determination, endowment effect, and reference transaction. Right? Now, as we've seen, this is entirely compatible with what the core model says. Right? The skilled obviously benefit from the wage premium. The employers pay it because it gets them what they want. They get the effort from their skilled workers, and they can afford to do so since the others are paying the same thing. Right? And interestingly, the unskilled are also accepting it because they get used to it, and by definition, they can't underbid the skilled. Right? Notice that I don't need to assume any particularly greedy attitude by the skilled workers, they're driving a hard bargain or anything like that. It just drops out of the way the bargaining process on the labor market works. Right? Now, there are some economic models that incorporate these kinds of assumptions, but they're few and far between. And what they don't do that I push really in this paper is that they don't emphasize the possibility of cumulative wage premium, more on which I'll say in a second. And secondly, they don't provide a normative evaluation of what we should think about these cumulative wage premium. Right? So this process that I've just described, that's what I call the centrifugal nature of the labor market. Right? And the key feature of the centrifugal nature of the labor market compared to standard models is that these wage premia can be cumulative. Right? And that's why the contrast with the marginal productivity and the perfect competition model is useful, because on that model, such a thing is unthinkable. It would be absurd to think that people can accumulate wage premia that are not competed away by competition. Right? But as we've seen, we only need to add a few tweaks to a more realistic, more empirically adequate model of the labor market to get these kinds of results. Right? So at this point, let me add two observations. Right? Someone might come along and say, how can this be efficient? Right? What should we think about this idea of a centrifugal nature of the labor market from the perspective of efficiency? Right? More specifically, might these cumulative wage premia, this extra we pay the skilled workers, might this be necessary to direct labor to its most productive employment? In other words, might it be necessary for an efficient labor market? Right? So my response here is the following. Right? It's plausible to me that some wage premia for the skilled are necessary to direct labor to its most productive use. Right? But it's not clear why cumulative wage premia, if they are a real phenomenon, would be necessary to send these signals. Right? From this perspective, a cumulative wage premium looks a lot more like an economic rent. Right? And everyone would agree that economic rents are not necessary for efficiency. Now recall that the core model already acknowledged that there are economic rents that are generated on the labor market, and that imperfect labor markets are, if you like, full of economic rents, right? So all my argument does is expand the definition, if you like, of what should count as an economic rent. We'll come back to that later if we have time. I should also add one qualification to my argument, and that is the following. So the fact that cumulative wage premia can be paid doesn't imply that the centrifugal nature of the labor market is visible on the labor market all the time, right? And that it operates with the same speed. Sometimes there can be countervailing forces that prevail. So just as social norms can internalize the wage gap between the skilled and the unskilled, social norms can also prevent employers from paying too high a wage premium, right? Nonetheless, what I submit to you is that these centrifugal forces are operating all the time. The question is whether they get through, right? So they are rooted in the way that the psychology of human beings is set up. The question is whether their results are visible on the specific labor market that we're looking at. So that's why the term centrifugal nature of the labor market is chosen with care. I think it really is part of how the labor market works when human beings are operating. So, do I have any illustration of this in practice? So here I have two suggestions. One is relatively close to home. So I've got this graph, which I can't show you now, but it basically, what it shows is that at a university in Canada, York University, it looks at the salaries of the top 5 executives over time, right? And it shows that, especially between the mid-90s and 2010, a gap opened up between the salaries of these top 5 executives at this university and the median taxpayer in Ontario, where this university is located. And this is without the content or the nature of the job of university administrators actually changing over that time period. Right? So what I think is interesting is that neither globalization nor technological change are really plausible candidates to explain this growing wage gap. Right? But the core plus model that I've just presented to you can make sense of it, right? By pointing to 3 factors, the 3 factors we saw in the abstract earlier. So first, student fees have gone up, right? On the product markets, there's more competition for students. The pay of university administrators at other universities have gone up. And there's a lack of unemployment pressure because university administrators tend to be tenured professors, right? So all these factors mean that university administrators can accumulate wage premia over time. So this is relatively a narrow illustration. Think of a much wider phenomenon, right? The wage premia that are paid for skills when university degrees are taken as a proxy for these skills. There's plenty of explanations for why such wage premia are paid. So people say this is a compensation for education and training that the person has done in the past, or there are barriers to entry, this particular market. So, someone might ask, well, what can this centrifugal nature of the labor market as an additional explanation, what can it add to these explanations? And here I would say, well, first, if it turned out, and it's more of a hypothesis than a proof that my phenomenon is real, if it turned out that we were able to control for these factors and there's some residual to be explained, well, then the centrifugal nature of the labor market would be able to fill that gap, right? And second, I think for any explanation in this context, it's a considerable challenge to not just prove that the phenomenon that one puts forward is compatible with the data, but it actually tracks the causal factors at work. Right? But this is just as much as a challenge for the other explanations, globalization, information technology, than for the explanation that I put forward here. Overall, in this paper, at least, my goal is certainly not to take on the empirical task of demonstrating that, look, here's the smoking gun, the centrifugal nature of the labor market is real. All I hope to show is that this phenomenon, to make this phenomenon plausible and to explain how it might provide a complementary explanation of income inequalities in the world. Okay, so let's now turn from the conceptual or theoretical part. This is what the centrifugal nature of the labor market is. This is how it works, to the normative analysis, right? So if it's a real phenomenon, right? If there's something to this idea, are income inequalities that come about in this way just or unjust? And this depends, of course, on the criterion of justice that you adopt, right? Now, in the paper, I show that 3 normative criteria often used by economists will all come to the conclusion that these kinds of inequalities should be considered unjust, or at least neutral from the perspective of justice. For reasons of time, I'll just concentrate on one of these criteria here, right? So suppose that people think that workers should get paid in proportion to their individual contribution to the productive process. Right? And incidentally, as we saw, this intuition is actually shared by some of the advocates of marginal productivity theory. Right? Now, in marked contrast to marginal productivity theory, though, the core model explicitly acknowledges that wage determination involves the distribution of a cooperative surplus. Right? There is this bargaining going on between employers and employees who gets what part of that surplus. Right? Now, of course, different people might have different ideas as to what the distribution of the cooperative surplus should be. I've thought about that in other work, but that's not the point here. The point here is that the accumulation of wage premia due to the centrifugal nature of the labor market will sooner or later violate this criteria. Right? Think about it. Suppose that at time t1, the distribution of the surplus adequately reflects individual contribution. Suppose also that this individual contribution doesn't change over time, but what changes by construction, as we've seen, is the cumulative wage premium that gets obtained by the skilled segment of the labor market. Right? Now, if the distribution reflected individual contribution at time t1, it can't be the case that it also reflects it at time t2, right? So the conclusion I come to is that over time, the centrifugal nature of the labor market will detach incomes from individual contribution, right? Which means that if this is your normative criterion, you should consider the centrifugal nature of the labor market as unjust. Now, of course, this argument doesn't show that the centrifugal nature of the labor market is unjust, period, right? It's a conditional argument, right? If this is your normative criterion, then you should consider it unjust. And as I said in the paper, I also do the same exercise for utilitarianism and for Pareto optimality. We can come back to that in the Q&A if you like. Right? Now let's move on, because I think there's a particular interest for political policy questions at IIEP. Let's move on to the question of how we should react politically to the centrifugal nature of the labor market. So in other words, if it's a real phenomenon, And if it's true that from several different perspectives, we should consider inequalities that come about in this way as unjust, how should we react to this phenomenon? Right? Now, here's what's interesting in this context. I think that we have reason to think that the standard remedies that we think of when we think of fighting income inequality might be ineffective against this particular determinant, the centrifugal nature of the labor market. Let's run through some of them. So the first candidate I discuss is better education and training. Right? Now, of course, education and training are important, right? But notice that what matters for on the centrifugal labor market is not the absolute skill gap, but the relative skill gap. Right? So as long as there are some people who are easier to replace than others, their bargaining power will be limited, and some others will be able to accumulate wage premium over time. Right? So for this reason, education and training for the less skilled, while empowering and important in other ways, I think might be partially ineffective to counteract the centrifugal nature of the labor market. Right? Next candidate. Well, what about progressive taxation? Why don't we just tax the skilled who earn more? Right? Why don't we tax them more? Right? So I completely agree that this would be effective, but I think that it faces considerable feasibility constraints. And the interesting thing is that these feasibility constraints arise from exactly the same phenomena that animate the centrifugal nature of the labor market, right? Namely the endowment effect and the reference transaction. So start with the endowment effect, right? Psychologically, those receiving wage premia, as we saw, quickly develop an entitlement to these wage premia. So this means their employers will be reluctant to take these away because it undermines their motivation. But it also means that politicians will be reluctant to take them away because people are less likely to vote for them. Right? In this context, I think there's an obvious link to the great book by Lime Murphy and Thomas Nagel on the myth of ownership, which is already almost 20 years old now. So second, the reference transaction, right? Once the cumulative wage premia become the reference transaction on the labor market, as we saw, even the less skilled will perceive them as fair, right? So you'd be hard pushed to expect a political initiative from them to get rid of them because they accept them as normal. They're not going to try and do anything about it. Finally, let's look at a third standard response to income inequality, namely strengthening labor unions. Now, at first sight, this looks more promising, right? If the problem is one of asymmetric bargaining power, then you give more bargaining power to the weaker party on the labor market, right? But as the core model shows, when threatened with layoffs, unions often negotiate for job security rather than for higher wages. Right? So even though strengthening unions might be part of the response, I think it's unlikely to be sufficient. So where should we look instead? And here I build on a quote from Anthony Atkinson, one of the foremost experts on income inequality. He thought if income inequality comes from power inequality, then basically to fix it, you need a countervailing power, right? So the thought is there a way to limit the use to which the skilled can put their bargaining power on the labor market? And let me emphasize again that from the perspective of my account, the problem is not the very existence of asymmetry in bargaining power, but rather the accumulation of wage premium that this asymmetry makes possible. Right? So one possibility, one political response might be to limit the ratio of wages at the top of the labor market and at the bottom of the labor market. The Swiss, for instance, voted on a proposal like this in 2013. It got rejected. Maybe it was too ambitious. But that's the kind of approach I think that should be favored once we take seriously the centrifugal nature of the labor market. I think in the interest of time, I'm going to, for now, skip the objection from efficiency, but I just want to maybe close by getting back to something that I said at the beginning of this talk. So what changes from a broader social perspective once we think about at least a part of inequality? I'm not saying all inequality comes about in this way, but what changes once we take seriously the idea that some part of inequality comes about in this way? Right? Now, standard analyses of income inequality as a demand and supply phenomenon, as we saw in the beginning, will consider any departure from the market equilibrium as costly in terms of efficiency. Right? So on that perspective, all you can do is either try to redistribute ex post, even though that also has efficiency costs, or try to influence the distribution of skills through education and training ex ante. And we saw the limitations of that a minute ago. Now, on the view that I've defended here, there's a lot more discretion in the market process. Right? So as someone like Nobel laureate Amartya Sen likes to put this point, a market is only as good as the environment that it's placed in. Right? So rather than thinking of this idea of a maximum wage or a maximum wage ratio or of other potential remedies to the centrifugal nature of the labor market as an intervention in the labor market, or as something that weakens market forces, I think we should rather think of this kind of approach as choosing a different set of market forces. Right? There's no such thing as the free market. They're only different markets. And I don't see why a market that works within the framework of a maximum wage ratio would necessarily be less efficient. I'm sure we'll come back to that in the discussion. So I believe that a maximum wage ratio would actually make the labor market more democratic in the sense that it would limit the power differentials between the participants on this market. So to conclude, I've tried to defend 3 points. Right? One is the theoretical conceptual point. Look, there's this determinant of income inequality that we neglect, namely the centrifugal nature of the labor market. This is how it works. Right? Second, here's why it's unjust on the basis of certain normative criteria you might want to adopt. And third, well, if it's true that this is real and that it's unjust, here's how we might want to go about it. And here's how we should not go about it. Right? The interesting thing is that you can accept these in a kind of pay-as-you-go scheme, right? Someone might accept only the theoretical bit, or someone might say, okay, I buy the theoretical and the normative bit, but not the policy bit. Or you might adopt all three, and we'll hear in a minute why Kathryn, where Kathryn sees the obstacles, and the rest of you too. So thanks for your attention, and I look forward to the discussion.
Thanks very much, Peter. That was a great tour of the paper and a really interesting discussion. So we now turn to Kathryn Holston for our comments.
Thanks, Jay, and IIEP for inviting me, and Peter for letting me read this paper, which I think is incredibly thought-provoking. And so I just want to start by saying I really appreciate this 3-point framing of, is this a plausible determinant of income inequality? And then if it is, should we care about it? And is it unjust? And then if we do, what should we do about it? So I'm going to also kind of leave the policy for the discussion because that's not my area of expertise. But Peter's given us a great summary, but highlighting what I see as the key points. The assertion here is that the very structure of the labor market itself is going to be an additional driver of income inequality. And so what he means by structure is that we know labor markets aren't perfectly competitive in reality, and this is a thing that economists accept, but we don't necessarily think about how the deviations from that perfect competition benchmark have important implications for both the actual distribution of labor income that we see, and also for whether or not we think this is normatively justified. And so I'm going to skip. I think we have a good sense of what the centrifugal nature of the labor market is. But the key point here is that there's going to be a growing wedge between wages earned by workers at the top of the labor market and those at the bottom. And so for the why should we care about this part, this is telling us that there's potentially a force by which on its own inequality is going to increase over time. And so if we stick to the kind of physics diagram of centrifugal force pushing out and centripetal force pushing in, what this is going to mean for policymakers is that if we sort of think of, this would be better on my slides, but if we think of the outside of a circle as kind of a level of income inequality that we've accepted for other reasons that we're not going into here as justified or allowable, then we can say, if we actually want to stay on that circle at that level of income inequality, then we're going to need a policy force that's continuously pushing and not just giving us a one-off reset to the level of income inequality, given that we have this opposing force, which is kind of continuously pushing us in the other direction. And so again, this is kind of an equal and opposite force that's going to have to be sustained. And so I think the case that this is an important and plausible determinant is really strong in this paper. And with my economist hat on, where I want to kind of push Peter is to formalize a bit the mechanism of the centrifugal force and maybe lay out the model a bit more. So keeping in mind that the claim we're evaluating here is without regulatory intervention, the labor market is going to drive a growing wedge between these two sets of workers that we're considering. Since we're in the Rethinking Capitalism and Democracy series, I feel the need to say that there's a growing conversation about the use of skilled versus unskilled as terms. I really dislike these terms, but I also, this is not, at all on Peter, and this is very standard in the field. But I'm going to think of the skilled workers as marketable skills that are attracting a higher value. And so we have these two groups, and I think it's pretty standard to accept that there's a group of workers that have a larger amount of bargaining power, and that this is the basis for an initial wage premium. And so going through the three time period process that Peter laid out, we have some initial baseline wage, and then in the initial bargaining period, there's going to be a wage premium that falls out of this because of the fact that this bargaining power differential exists. And so is this justified? Maybe we could debate this from a bunch of different angles, but either way, we're sort of saying that this derives from some sort of actual gap in skills or actual difference in bargaining power that exists. And then because of the behavioral phenomena, we see that over time, the baseline shifts such that the initial wage premium becomes what I'm going to think of as the new baseline. And at time 3, where we again bargain and end up with an increase, this is where I would push Peter to kind of specify how this is going to happen. So the way that I'm conceiving this is because of these behavioral biases, we almost forget that the bargaining power has already been used up in order to get us to this initial wage premium. And so when we bargain again, we're starting with this baseline that we've now all internalized, which is an existing wage premium. And then during the bargaining process, the skilled group with additional bargaining power is going to be able to extract another additional wage premium on top of the first one. And so the question is, can this be justified? And it seems pretty straightforward that it can't be justified based on the same difference in bargaining power that we had in the initial bargaining. And this is what I take Peter's point to be. And so my sort of first set of questions is, what happens next? So is there a limit here to how much this wage premium can accumulate over time? And I know that, it's outside of the scope of this paper to kind of build an equilibrium model with all of the countervailing forces, but I would just be really interested in how would this be sustained in an equilibrium? So does it kind of go to infinity that we get this huge wage premium for the skilled group, or is there something that's going to eventually pull it back in once we reach a certain point? And then on the sort of normative side, I'm interested in hearing more about where in this mechanism we would place the kind of unjust piece. And so is it that it's this exercise of bargaining power, and then the policy response is that we want to either remove some of the bargaining power or apply an opposing force so that the skilled workers can't extract this premium? Or is it, maybe that we want to boost the wages of the unskilled workers? Is this two sides of the same coin? So sort of leaving that there for now, I want to turn to something that I think could be a really nice empirical testing ground and application for this theory, and that's the area of CEO pay. So this is a really large theoretical and empirical literature. It's kind of growing, and there's a bunch of explanations that I think would interact interestingly with Peter's theory. So as a starting point, we see the same principal agent problem come up here, where we want our CEOs to do something, and we're going to incentivize them to do that with higher pay, but they're self-interested, and we can't necessarily enforce their level of effort. And so, again, as Peter mentioned, it can be optimal for the firm to pay them more than maybe a market rate because we're trying to induce some sort of effort. And so this is one avenue through which we can justify this higher pay. I had a chart from the Economic Policy Institute that shows the ratio between CEO pay and average worker pay has just exploded since the 1960s. So in 1965, an average CEO made 21 times more than an average worker. And in 2020, it was 351 times. So just a catastrophic increase. And so some of the explanations are similarly that CEO bargaining power is really high because they're a scarce pool of talent. the superstar explanation by Gebex and Landier that as we get an explosion in market size from globalization and technology, the marginal benefit for having a better CEO is just so much higher. And so it's worth it to pay them more, fitting in with the kind of supply and demand explanations of wage that we see. And I think this would be a great area to bring in possibly this centrifugal nature of, is it the case that, you know, they do have more bargaining power for a reason and these explanations are justified, but then we just see this explode over time. And so sort of using this as a segue, I think it's really useful to think about actually three groups. So those in the top 1% or the CEO group, and then maybe you know, the group of college educated workers, or what we're thinking of as the skilled workers here, and then the lower wage workers. And so one area that intersects quite nicely is the literature on the labor share and on worker power. So I know that Peter intentionally abstracts away from labor and capital differences, but in work by Anna Stansbury with Larry Summers, they find that declining worker power can account for a large share of the decline in the labor share, so the amount of labor versus capital that's going to workers, particularly for the bottom 99% of the workforce compared to the top 1%. And so there are, at the same time that we see growing differences between the skilled and the unskilled group because of the bargaining power of the skilled workers relative to the unskilled, we might see the same dynamic where the unskilled workers in particular are losing bargaining power with respect to capital, so with respect to the firm side. And so this could kind of be a double whammy for low wage workers, where they're hit worse by the centrifugal nature of the labor force, and they're also hit worse by this decline in labor rents over time. And so I will stop here because I really want to hear Peter's response and the discussion, but thank you again for inviting me to be the discussant.
Thanks very much, Kathryn. Those were terrific comments. And I'm wondering, actually, Peter, if you want to, before I ask additional questions, if you want to just maybe respond to anything Kathryn said, and in particular, I guess these kind of two of the questions asked there, kind of one on what happens next. Does this just kind of go off to infinity, or how do we think about the bounding in some sense, and what forces are there to do that? And that second one of what specifically is unjust here? Is it the gap? Is it the pay the lower wage workers are getting? Is it the pay the high wage workers are getting is too high? You know, what specifically is troubling us there?
Thanks. Yeah, I'd love to respond, and I have to be careful not to take up the rest of our time in responding to these great questions. So, as Jay suggested, maybe let me try to focus on a few issues. So, is there a limit to this, right? So I like to think of it by looking back in time, or also by looking across different cultures and seeing that what I think is happening is that there are social norms of fairness that are in place in some places at some moments of time that kind of provide this counteracting force to the centrifugal nature of the labor market, right? And sometimes those forces prevail, right? So, for instance, you could argue that in the post-Second World War period, right, those forces were strong and they managed to keep in check the centrifugal nature of the labor market. And then at other times, in other places, maybe in the Anglo-Saxon model of capitalism today, those other forces are not as strong and are not sufficient to check the centrifugal nature of the labor market. Right? Are there limits to this? Well, I think psychologically, at some point, the kind of normalizing effect of the reference transaction that I was talking about, it will just become implausible. Right. So right now, CEO pay, as you said, is already at, rather than at 20, 30, 40 times, is at 300, 400, 500 times of what the factory floor worker takes home. Right. So at some point, it just becomes implausible. Right? So that's when I think the model breaks down. But I think the risk is that the model breaks down in a rupture rather than in a politically controlled way where we say, okay, we will counteract these tendencies through political means, through a maximum wage ratio and so on. Right? I want to pick up on one thing that you said about the, I like the way you put it when you said, so the baseline shifts, right? The bargaining power of the skilled segment of the labor market gets them a premium, and then we forget that they've already used their bargaining power. Right? Now that formulation, I think that looks at bargaining power as a stock that depletes over time, right? And I'm not sure, but I haven't thought about this in detail, but I will now. I don't think that's the right way to think about it, because their relation to the others on the labor market is still the same. So the bargaining power hasn't diminished in any way. It's not like politicians who use their political capital, right? The upper segment of the labor market, they don't deplete their stock of bargaining power if they use it again, especially if it's been normalized in the meantime, right? And just two more comments. So where exactly is the injustice? So in the presentation, I did spend the least amount of time on that aspect. So I think, as someone who does normative work, I think it's very important to kind of put your normative cards on the table, right? So just like we have to put our conceptual or descriptive cards on the table when we analyze how does the labor market work, right? You've got to put your normative cards on the table. So again, I would emphasize that it's a conditional argument, right? So if you adopt that idea that workers should get something that corresponds or is proportional to their individual contribution, then certain things follow for how you analyze the labor market. To give you one of the other criteria that I didn't develop in the presentation, but that's in the paper, utilitarianism, right? So if utilitarianism is your normative criterion, right, then you've got two considerations to take into account. One is you want the market to be efficient in directing labor to its most productive use, right? Because that will generate wealth, so that will maximize utility. But at the same time, if you think that everyone has a similar utility function, then you also know that more equal incomes will get you more utility, right? So if you take those two together, then you want the minimum amount of income inequality necessary to fulfill the allocative efficiency function of the market, right? And so again, from that perspective, you'd come to the conclusion, or I argue that you can come to the conclusion that cumulative wage premium, because they're not necessary to direct labor to its most productive use, are unjust. Right? To close, so I love the stuff about CEO pay, and I think there's some really illustrative remarks. If every country kind of has their great industrial person who at some point in the late 19th, early 20th century said, we need to pay our workers properly because they're doing the work. Right? So that is an example for a social norm that kept the centrifugal nature of the labor market in check. And I think over time, I think we've lost in many places that kind of attitude, and therefore the door opens for more wage discrepancies. And I'll definitely think about what you said about the labor capital share. I also think about that in other contexts, but I deliberately bracketed it here. And I think there's potential to bring the two together again. Thanks so much for great questions.
Great. I want to encourage the audience. For those of you who are here at the start, you're aware that we had a Zoom security issue at the start, which I very much apologize. There were some changes in settings. So if you have questions, you can email them to IIEP@gwu.edu, and those will get passed along to me. The number of questions I want to start the conversation with. Peter, I want to start with something, actually picking up a little bit on what Kathryn said. I also know that the literature uses skilled, unskilled, and I've noticed, especially I feel like in advocacy circles in the US, there's been a real push away from unskilled for the very reason that there's a Starbucks in the basement of this building, and I certainly could not make a latte. I don't have the skills they have, but the skills I have get compensated more. And in many cases, we run into that. And so I raise this in part because there's a nice discussion in the paper around this, which I know you didn't have time to get to. So I wanted to maybe encourage you to flesh out a little bit of what you mean by skilled and unskilled. And in particular, because when I was reading your paper, I kept thinking in the back of my head up until around page 10, but what about people like childcare workers who have degrees in early childhood education, who have a lot of skills, but don't get paid well? And then you talked about that some. And so I guess I'm just wondering how do I think about the division between these two groups? Is it education primarily, but then education doesn't map perfectly? So how do I think about who's in which group?
Thanks, Jay. This gives me an opportunity to come back to this very important point also raised by Kathryn. I think you were perfectly right when you said, well, we should think about marketable skills, right? And the reason, or skills that attract value on the market, right? Because we kind of have two categories which are actually problematic in different ways. So we have certain things that attract value, right? But that maybe shouldn't attract value. So, people get wage premium because they're male or because of the color of their skin or because of their height or I don't know what, right? And they shouldn't get a wage premium because of those characteristics, right? So we want to bracket those and take those out of the realm of things that we're talking about here, right? So those are not what I want to consider marketable skills. And then we've got the other category that Jay mentioned. We've got people who have certain skills, but those skills seem to be less valued on the market, right? And so I think we have to think about how we make a distinction, especially between those latter two categories, and how we explain why certain skills on the market attract more skills than others. And here, I think, we'll plausibly have complementary explanations, right? So there certainly will be a demand and supply explanation that does some of the work here. But then I think the centrifugal nature of the labor market, especially at the top end of the labor market, could maybe also explain why certain incomes take off, right? So this also came through in some of the things that Kathryn said. There might be a double whammy, right? There might be a demand and supply explanation at the bottom of the labor market because globalization means that the unskilled segment of the labor market, I'd love a different terminology. So if you have one, just give it to me. They lose bargaining power. And then the centrifugal nature of the labor market means that those at the top gain more bargaining power. And that means we see this drift in two directions. I think another whole paper could be written just about that, teasing apart the notion of skills or marketable skills that we use here. In the paper, for obvious reasons, since I want to do the conceptual analysis, the normative analysis, and the political analysis, I only did so much of that.
Great. I want to actually, I think, and again, even more than in the presentation, you're very clear about this in the paper, that you are not claiming you have nailed down empirically that this is definitive proof of everything that's going on. And I appreciate that. But I wanted to pick up on one kind of fact that you did put out there, which is kind of the growing education premium, or the growth in education premium in the United States labor market from, say, like 1950 or 60 through today. And similarly, Kathryn pointed out kind of the much higher CEO to worker pay today than we had, say, 50 years ago. And the reason I wanted to bring it up is because in both cases, those premiums kind of flattened out after around the late 90s, in the sense that BA to high school wage premium in the US had kind of quit growing. It grew a lot, and then it's kind of flattened out. And the CEO to worker pay ratio, I think, peaked in 2000. And kind of continues to bounce around. It's incredibly high, right? It's at this high level, but it quit growing. And so when I look at inequality in the US, things like the income share of the top 1% or the 90% to 10% wage ratio, those continue to get bigger, right? So we're continuing to see growing inequality. That, in some sense, is part of what you're pointing to. But these specific things I could look at, CEO to worker pay, or the premium that shows up for education, those haven't been growing anymore. And so which makes me wonder, is there kind of growing inequality within the high education group or things like that? How should I think about, if it's not just the education or not just the CEO, what is it? Is this the right mechanism, or how do I think about it?
So I think I want to say two things here. I mean, the first is, I do have a degree in economics, but then I shifted over to political philosophy. So I don't do empirical work myself anymore, right? But I would love to get together with an economist and try to test some of the claims that I make in this paper, or build a model, as Kathryn suggested, that kind of translates this into economic speak, right? And then go out and test it and see, well, are there any aspects of income inequality in the real world that, at least according to the model that you've built, that's another methodological issue, you can plausibly explain in that way. Right? So that's one thing. And yeah, I think there's another thing I wanted to say. Maybe it'll come back in a minute. So I'll let you go on to the next question, and I'll come back to the other aspect.
Okay, thanks. And yeah, Sunil, did you want to hop in?
I want to ask a systemic question, in the sense that, Kathryn raised this idea of an equilibrium, which, I grew up studying equilibrium, but I'm sort of most skeptical about what one would call an equilibrium. Because if you're talking about dynamics, think about, we have reference transactions increasing this increase in wages, which may not be justified. And the limit could be only reached at some point where, it becomes implausible, but it already resulted in so much inequality, which has other effects. It could be greater political polarization. It could be, corrupting the political system, which makes it much more difficult, in some sense, to bring forward the countervailing forces that Peter mentions to redress these inequalities. And this wage differential argument that we're using, and as I think you just raised about income and wealth inequality, once you change initial conditions in such a way that there is a large amount of income inequality, then that itself creates a dynamic for larger wealth inequality over time, if the returns to a capital are much higher than, say, other returns, relative returns. So there, it doesn't have to be one dynamic. If you're thinking of the system as a whole, there could be multiple dynamics going on here, and that we are just, for argument here, focusing on the labor market. So I'd just like to push Peter a little more on that this is all endogenous in some sense, right? This is going to have feedback effects on how society is organized, how the rules are set, how political decision-making takes place. And that could be another dynamic to itself.
Yeah, I think so. I would respond to that. This is in a way grist on my mill, right? If you're correct, then there's a vicious circle in the dynamics around inequality and how our democracy functions, in which the centrifugal nature of the labor market is one cog in the overall machine, right? One cog in the big wheel. Because I completely agree with you that if there are contingent inequalities that are generated in this way, these will over time have other detrimental effects, right? So remember at the beginning I said, well, there's two ways to look at inequality. One is to look at the determinants, one is to look at the effects. But you're completely correct to say, well, if you're right about this determinant, then it might also have negative knock-on effects, right? So I could certainly make more of that potential interaction of this factor with other factors in the paper, and I think in response to your comment, I will. The other thing I want to pick up on in your intervention is the notion of equilibrium, because I think that is really a central one, right? So in rereading the paper, I thought, to what extent do I really need to talk about this marginal productivity theory? It's just going to annoy economists because no one accepts it anymore, right? But I think it's actually important to bring out the contrast between, is there discretion or is there no discretion, right? So once we move to something like the core model of the labor market, there's a lot of discretion. There are multiple possible equilibria. They accept that, right? But I think in the public discourse about the labor market, there is still this latent idea that stems from the old marginal productivity theory that we're oscillating around one equilibrium, right? And you seem to agree that this is problematic, right? But that's where it comes from. So maybe I should cut down that discussion a bit, but still keep it in there to make that point. So in a way, the passage from marginal productivity to core shows us that there is discretion, and then adding the features to core that I add show us how we should perhaps think about that discretion and how it's used. And I thought about what I forgot to say in response to Jay's comments too. So you said, look, some of these dynamics, CEO pay and the return on college education, they went up for a while, but then they stagnated, right? So I'm going to reiterate something that I maybe said too briefly in the presentation. I think the centrifugal nature of the labor market is there all the time as a force, but it doesn't mean that we see its results all the time in what happens on the labor market. Right? So maybe some other social norms kicked in. Maybe maybe we decided, okay, enough is enough for CEO pay, and then the centrifugal nature of the labor market is not able to manifest itself for further growth. Right? But that doesn't mean that the growth that we saw for that time period, if it was due to this, is justified. Right?
Thanks. This conversation kind of kicks over to two other questions I have for you. Maybe I'll ask them one at a time because that's easier than trying to load too many at you. But in some sense, they both come back to something similar to Kathryn's question about, what are the boundaries here? And so first, as you're asking, as you're referencing the marginal productivity theories, it reminds me of this one, which is in some sense, is there a limit to this discretion firms have in the labor market? And I'm thinking here because there are economists, as you've noticed, who started talking a lot more about monopsony and still often though lodging that with some productivity theories as part of the wage setting process, so that they have some boundary there that's coming, that there's a limit to the profitability. And so I guess I'm curious in this framework, what is stopping this ever, in a sense of like, does profitability become the boundary? What becomes the boundary to how much discretion the firm has?
So I would say from a normative perspective, right? So if you adopt that position that I alluded to in the presentation, right? If you think that individuals should get something that is proportionate to their individual contribution, right? So in my work on the cooperative surplus, I like to think of the question in those terms. What is the relevant counterfactual, right? What is the contribution of the individual and what is surplus, right? So if there's a lot of surplus, and contemporary economic models don't give a lot of space to the notion of surplus, but if there's a lot of surplus, right, then I think there's quite a lot of discretion in the distribution on the labor market, right? That's different from the question in the short term of how feasible different distributions of the surplus might be, right? So I would want to separate those two. If we think there's a lot of surplus, that means there's a lot of discretion. If someone says, no, individual contributions are actually more important than Peter thinks, then there's less discretion, right? And then we have stricter limits on how we might be able to contain the centrifugal nature of the labor market. But if there's a lot of discretion, if there's a lot of surplus, I think we could make a big shift towards more equal distribution of income without costs and efficiency, right? Now, separate that from the feasibility question of, in the short term, are we able to use that discretion in certain ways? It might be very hard, right? In a country that has high income inequality right now, to change the psychological attitudes towards this. And psychologists would call it the attribution fallacy, right? To get around the idea that it's really these CEOs, these individuals who make those important contributions. I would contest that. I would say that they are, they certainly make an important contribution, but they are part of a division of labor, and it's that division of labor, that corporation, that generates the wealth rather than the individuals. Right? So if that's right, then I think we have quite a bit of room for maneuver once we're able to change the individual attitudes to how the economy works.
So I want to turn because you spent a good amount of time in the paper, and I know kind of fell at the end of your presentation, is to talk a little bit about the kind of what we do, kind of the policy side. So if people kind of, as you say, accept stage 1 and stage 2 and want to do something about it, how exactly the max ratio would work? So that's actually just one question, is how are you envisioning this? Is it kind of within firm? Is it that there's a max wage for the whole economy? Is it by sector? How would one feasibly try to employ some sort of max ratio to push back on these forces?
Yeah, that's a good question. So what the Swiss tried to do is they tried to do it within firms, right? And they proposed the following. they took the number of months in the year as an inspiration, and they said within a firm, the multiplier between the lowest wage and the highest wage shouldn't exceed 12. Right? And even at the time in Switzerland, there were people who said, this is too radical. It's not going to go through. Take the number of weeks. Take 52. It's still a major improvement on the status quo. You might actually have a chance of it getting accepted. They stuck to the 12, and I think it was a 2/3 to 1/3 majority that rejected the proposal. Now, I see a certain weak spot in a proposal that looks at firms, and that is, there are more profitable firms and less profitable firms. So if you work for a more profitable firm and you get the 12 times as high as the lowest paid employee, you might still have several hundred times as much as the lowest paid employee in a less profitable firm, right? So as a social phenomenon, it might not go all that far. But then I accept that implementing this kind of thing on a society-wide scale, right, requires quite a bit more of hammering out how it would actually work, right? So would we say, look, in a way, it would be a minimum and a maximum income at the same time that we accept, right? Suppose we go for a factor of 52 or 100, right? How do we ensure? I think it would be relatively easy to ensure that the minimum wage would then be at a certain level. But what happens, for instance, at the higher end of the labor market, right? Will there be a bunching up at 52 times the pay of those at the bottom? In which case, the price signaling function of the labor market might, in fact, be undermined to some extent, right? So I think that's certainly an aspect that would need more fleshing out, and I think I'll do that in future work.
And so, yeah, Kathryn, go ahead.
I just wanted to sort of come in and flag that, in line with this broader series, I feel like this question really gets at, do we care about poverty and establishing a minimum floor? Do we care about income inequality throughout the entire distribution? Do we care about sort of extreme top-end wealth concentration, or do we care about, kind of all three? And of course, different people are going to pick different ones. But I think that it would be interesting to sort of, for each of those, think about whether this policy is the best to accomplish that goal, or, if it can sort of accomplish the top and bottom goals at once compared to other policies that we have available for each of those functions.
And if I can add, that's in a way why at the end I said, you can accept this in piecemeal fashion, because I completely agree that in the political response, if I'm correct in thinking that some of our standard responses are partially ineffective with this phenomenon, right? There's a lot more to be worked out on the maximum wage ratio. I accept that, right? But if I'd managed to convince you that the centrifugal nature of the labor market is real and that it's unjust, I would take that. I'd be happy with that already. So we could then work out together what we need to do.
One other question about just how you would think about this if you were doing it at the firm level. One of the things that pushed me to thinking about is people who are worried about fissuring in the labor market, that firms start to basically outsource, not to a different country, but just within their own country, all the services of their lower wage workers. And would a max ratio kind of encourage that, basically, that if I want to give myself a raise, I have to fire all the cleaning services people and instead just outsource it to a different firm, so they're no longer my employees. That's what makes me worry about it. On the other hand, I just did want to flag people who study that, I think in some ways are pointing to similar mechanisms that you do, where they're saying there is almost a normative piece of, you can't let the top make too much more than the bottom within firm. And so the solution the people at the top find to that is get rid of the low wage people so they no longer are employees, because we want to offer really great benefits to everyone who's an employee, and we don't want to have to offer it to the people further down. So we just offload them. So in that sense, I think those normative features really do point to the same things you're pointing at, but as then a practical matter to try to combat it, wouldn't that be one of the issues you'd run into?
No, I completely agree. I mentioned earlier only the idea that you've got more profitable firms and less profitable firms, and there would still be income inequalities due to that. But you're completely right that fissuring actually is another major issue. So I just recently read Alexander Rosenfeld's, I think the title is something like, you get paid what you deserve or something like that. And he documents in the United States how important a phenomenon this fishing has become, right? And it's, yeah, I completely agree that if you only had a maximum wage ratio within the firm, this would create an additional incentive to basically outsource lower paid workers in order to be able to raise the wage for the higher paid ones. So that's another argument for in favor of coming up with a feasible way to do this at a society-wide scale, rather than within the firms, right? Which then raises the other question: well, could a society go it alone? Could we do this, I don't know, in the US or in Canada while it's not being done elsewhere? Well, I think there's some room for maneuver, but maybe not as much as we would like, right? Because already today, some countries, the Scandinavian countries, have less income inequality without all the higher income people running off to places where they could get paid more, right? There is some room for maneuver there to control things. But of course, that room for maneuver has certain limits. Once the gap becomes too big, then you do see an important effect.
Thanks. One of the questions that came in to us is asking, is one of the reasons you don't see more pushback on this inequality? Because in a sense, the people who are getting the lower wages, have the less marketable skills in some sense, or the skills that are not being highly prized in the market, that they hope that they will wind up on the other side, right? That they think, well, I don't want to stop the good outcomes because I'd like to get to that good outcome. And, I don't, similar to people saying, if you said, I'm going to tax only people above $1 million, that people might say, well, what if I am there one day? I don't, and even if they have unrealistic hopes of getting, is that part of what stops a broader political pushback?
So it's interesting. It's a shame that we didn't have the slides, because it's not a perfect illustration of the reference transaction, but the slide I had to illustrate the reference transaction is a cartoon from the New Yorker, where you got two guys sitting at the bar, right? One portrayed as rich and one portrayed as poor. And the poor guy says to the rich guy, as a potential lottery winner, I support tax cuts for the rich, right? And it's one of my favorite New Yorker cartoons ever. I had it on my office door, and it captures that idea, right? It's not only that the lower segment of the labor market kind of gets used to this wage gap, that it becomes normalized, right? But there might also be this latent hope, maybe one day I'm going to make it big, right? The American dream, right? There's this illusion that the mobility in the labor market is still there, and maybe one day I'll be there, and then I wouldn't want to, have a maximum wage ratio or a highly progressive income tax system. So that I think it's plausible that is part of the explanation. I have no way of teasing out how much. I suspect that the normalizing effect of the reference transactions is actually playing a bigger role here. But who knows? It's a very interesting thought.
And so you addressed this a little bit. Sorry, Sunil, did you want to hop back in?
The question I wanted to ask was that we're sort of moving away from economics more into the social realm. So I think, and as economists, we don't study sufficiently the formation of norms. And you could expect in certain societies, because certain norms hold, they desire, or they express their desire through the political system for a particular kind of society. And I think that's something we as economists try to say, can we measure this? Can we not measure this? At some point, it's about human beings. It's about morality. It's about society. And I don't think, for example, even as economists, when we ask the question, how do you measure individual contribution in really complex organizations, especially complex organizations which are not making widgets? It's not easy to do so. But we still live with that uncertainty, and within organizations, people create certain cultures, and that at times determine whether certain organizations succeed while others fail. So I think in some sense, the question has to be broader than economics. It also has to be what kind of a society we prefer to live in. Do I want to have a Maserati and no infrastructure to drive it on? Now, this was an issue that Bob Frank raised, that at some point the rich should realize that if I could have the best cars in the world, but if there are no roads to drive them on, they're useless. And at some point you say, no, I'm willing to pay my taxes so that the infrastructure is good. So I don't get a Maserati, but I can drive some other luxurious car at high speed and enjoy it. So I mean, I don't know whether I'm following Peter's lead, but at some point, these things have to go beyond purely economics and measurement.
Well, I completely agree with everything you said. So, for instance, Philippe van Parijs, who's thought a lot about income inequality, he suggested at some point that, more than is the case today in many countries, other social institutions than the state actually fulfilled certain redistributive functions in our society, right? So he talks about the family, but he also talks about firms, right? And he said that firms, by if you like, keeping a lid on that income inequality, right? They to some extent play part of a role that today we attribute all the way to the state, and the state has its hands tied because it's almost political suicide to suggest a more progressive tax system. That might be changing now, finally, right? But for the last 20, 30 years, there was only one trend in that context, right? So that's where the broader picture comes in, right? If it's true that other institutions in the state, because they adopt and then sustain certain social norms, can play a role, then that's something that we need to explore, right? But on most economic models where it's kind of maximization of a rather narrow utility function, that's not going to happen, right?
I wanted to ask one concern about anything, whether it's a max wage ratio or really anything that is trying to target the labor market outcome in terms of pay directly, is how much of a concern is there that just the very high income people, the top 1% or above, are frankly just very good at relabeling their income however they would like. And this goes a little to Sunil's point about, is it within labor market that the problem is, or is it labor to capital? But if you tell me as a lawyer at a law firm, I have a max wage, then fine, we have a partnership. We're not going to take our money as wages anymore. It's all coming as profits and we co-own the firm. Or if you tell me as an employee somewhere, I'm capped out, I say, fine, I no longer work for the firm. I'm now an independent contractor who owns my own firm, and all of my earnings are now capital earnings, not wage earnings. And kind of all these games. And you see the sensitivity even when there were changes in the tax code across what a small business or a contractor would have to pay. And suddenly income floods from being wages to being that type of income. So to what extent does that flexibility for people at the top kind of challenge any attempt to constrain it other than through societal norms or taxes? That any kind of direct intervention in the wage market is hard.
I think that's a very important point. I mean, I like to use an example from optimal tax theory to illustrate what can and what can't be done here, right? So optimal tax theory basically said, look, taxing people more comes at a cost because they change their behavior, right? Now, in the early days of optimal tax theory, people said, well, they change their behavior by working less, right? And in this case, there would be a real cost to social welfare as some of these highly qualified people kind of reduce their input into the labor market, right? But today we have studies from various economists that actually question that empirical premise that high earners will reduce their labor supply. They argue that their labor supply is actually relatively inelastic, right? But the interesting thing is that optimal tax theorists then in a later stage also started looking at another kind of behavioral change, right? Not reducing your labor supply, but basically evading your taxes, right? And so, or relabeling your income as something else, right? And so if you apply optimal tax theory kind of in a simplistic way, you see, look, these guys are changing their behavior, so we shouldn't tax them because we're going to have less revenue, right? I think the more sophisticated application of optimal tax theory would then be to say, well, we got to make it harder for them to change their behavior in that way, which is a way that we don't want them to, that's a way that we don't want to be open to them, right? So I think that the answer to your question, Jay, from me lies in our possibility as a society, right, to make the tax code or the maximum wage ratio, or whatever instrument we apply, right, make that stick and make it harder for those at the top end of the income distribution to circumvent the spirit of the regulation or of the taxation in question. Right? So rather than not taxing them because it would be costly in terms of social welfare, I think we should plug the loopholes, which would make it more efficient to tax them. Right? Then optimal tax theory, once the loopholes are plugged, optimal tax theory would say, yes, do go ahead and tax them because that's the efficient way to do it. Right? Kathryn has a point on this, I think.
Yeah, I think there's a point of optimism that we can also inject here, which is that, this is a sort of another plug for thinking about things comprehensively in terms of differentials within the income inequality groups, as well as labor versus capital, because if we are able to change the norms and if we are able to, increase unionization and increase bargaining power at the lower end, that's going to, in fact, sort of get at both of these problems.
Thanks. So I'm noticing we are just about out of time. And so I want to first, before we wrap, give an opportunity for any last comments, either from Kathryn or Peter, if there's any way you want to wrap up. I think it's been a fascinating discussion, and I really appreciated the way you in some sense encourage the audience to think of it in chunks and say, there are important contributions being made in each area and to consider them. So any last comments from either one of you?
Maybe I'll say one thing, Kathryn, if I can go first. So, I mean, one point that I haven't discussed at all is, suppose this is real, the centrifugal nature of the labor market, right? To what extent is this a significant phenomenon compared to the other explanations of income inequality, which I don't deny, right? There's this complementarity. So the next step, if you like, would be to as Kathryn and Jay also suggested, right, go out and try to come up with a way to measure the importance of this phenomenon if it's real.
Yeah, and just building on that, I mean, I think that you have me totally convinced that if this is real, then it's important and we should care about it. And so that's a really strong argument for building a further research agenda in terms of quantifying it and sort of trying to interact it with other mechanisms and so on.
Great, thank you. I think that's a terrific last word. And so once again, thanks to Peter and to Kathryn for sharing their insights with us today, and to Sunil for helping co-organize this session. Thanks everyone for attending and for the questions and thoughts that you passed on to us. And once again, please look at the website for future events that we'll be holding in this series. Thanks very much.